If you could be chairman and CEO of McDonald's for a year, what would you do to turbocharge the business? What would you do to double the value, the intrinsic value of that business in 3 to 6 years or maybe more? If I could be the chairman and CEO of McDonald's for a year or for a couple of years, what I would want to do is reinvest more in building out our restaurant business. And the way that I would do that is I would look for any brand in my space that I think is competitive or could become very competitive with my backing. Today, I think that's Shake Shack. And what I would do is I would borrow the money to buy Shake Shack. Let me tell you why. Welcome to the inaugural edition of the Power Law Investing Podcast. I'm your host, Porter Stansberry. I'm the chairman and CEO of MarketWise, Inc., which is one of the largest purveyors in the world of independent financial research.
And I'm your co-host, Whitney Tilson. I ran a hedge fund for a lot of years and have been part of Stansberry Research now for the last 6 years as an editor and director of research.
And we're here to help you guys find the kind of investments that you can hold for a lifetime. What we have discovered throughout our 25 plus years as researchers and investors is that strength tends to accrue to the strongest companies, and that most of the gains in the market therefore accrue to a very small number of power law winning stocks. We're here to do some deep dives and to introduce you into some new ways of analyzing the very best investments on the public markets. One of the most interesting things about the financial markets is that they are not normally distributed. Lots of studies have been done over the years about a median investor result, and it's usually something like 3.5% to 4% a year. Meanwhile, there are a handful of investors who have made outlandish returns on the stock market. Returns like 15% annualized, 17% annualized, 22% annualized. And we know some of these investors. And the striking thing is that the financial markets follow a power law where most of the gains accrue to a very small number of people. The Pareto principle is in full effect. The results are not normally distributed.
I've seen studies going back 50 years or 70 years, something like 2% of all the stocks in the public market account for
80% of all the gains.
80%.
Pareto's law.
Exactly.
And this year's no exception, right? If you look at the big 5 tech stocks, they're now responsible for sometimes it's even more than the total return of the market because net basis, the other stocks have not done as well.
Right.
So what we're trying to do with this podcast is help you understand what kinds of businesses are winners in this power law distribution. Tilson, where should we start?
Well, let me just give a little bit of background and then we can share with our audience the company we're going to talk about today. Over the years, I owned hundreds of stocks of all different types, beaten down, low-quality companies. I also own some of the greatest businesses of all time. And foolishly, I knew they were obviously great businesses, but I sold them much too soon. And 25 years into my investing career, I'm convinced that the surest route to long-term wealth creation is to first identify the long-term compounders, the greatest businesses in the world that can grow and grow, and then be patient and wait for the opportunity to get into them at reasonable prices and then hold them for 10 years or more.
And that's a big goal of this podcast. The other thing I would echo is going to open and shut very quickly because of the advent of AI, because of quant trading systems. It is very hard to get great opportunities that last. The window closes very quickly. When we recommended Domino's about a year ago, I think you had 12 trading days to buy it under our buy price, which was $300. Now it's at $550. It was 12 trading days. So we want you to know which companies that you want to own for the long term and be ready to buy them at the appropriate price. And we've been around the markets long enough to know what it looks like and what it smells like. And we're going to help you find those stocks so that you can move more and more of your investable assets into the power law winners. And of course, we'll help you identify when that moment arrives too. But it's awfully hard to do a deep dive on 24 different businesses in a week-long period when the market's crashing.
And those stocks tend to have some common characteristics that you and I have identified over the years. My mentor, Charlie Munger, said the way life and investing work, you can get impatient and frustrated. He says it's during those flat periods, maybe when you're getting impatient and frustrated and all, that in fact you're doing all the things to be prepared. This is not a great time today, and with the market hitting 30-something all-time highs this year, there aren't a lot of huge bargains out there, so it's harder to find attractively priced like the ones we're looking for. But we intend to be doing this for a while. Every episode, we're going to do a deep dive into one company that fits that category. May not be a buy at today's price, but you've got to develop a knowledge that you're ready to act and add them to your portfolio when the market makes a mistake and gives you a great chance to get in.
And as we thought about companies that may be able to do that, if I had to bet on one company that could outperform the market over the next 30 years, it might be McDonald's. And so we're here today to talk about what makes McDonald's so special as a business. And we want to start with how it was created. So we're going to go back in time to the two brothers, Dick and Mac McDonald. Dick and Mac grew up in rural New Hampshire. They grew up in a family that was obnoxiously religious, and they rejected all that. So as soon as they were finished with high school, they drive across the country to Southern California because they both want to be in the movie business. And you think about how hard it must have been to drive across the country at that time. There's no highways. They've probably got Model Ts or something like that. They're changing the tire every 20 miles. They drive all the way across the country, and they get a job working for this comedian, Ben Turpin, building his sets and moving them around. They save up enough money working for Ben Turpin to lease, in 1936, a movie theater was their first business, and they can't make any money with it. In fact, they ran this business for 3 years, and they never made enough money to pay the monthly rent, which was $100. So it was only their landlord's forbearance that kept them in the movie business. Meanwhile, car crazy LA is booming, and there's a new kind of restaurant called the drive-in. And the first one was called the Pig Stand, and it opened in 1932, right at the bottom of the Great Depression. The brothers, Dick and Mac, saw the success of this, and they thought, I bet you we can do the same thing. So they opened their very first drive-in in 1937 in Pasadena. And ironically, it didn't even serve hamburgers. It sold hot dogs and milkshakes. 3 years later, they'd made enough money doing that to buy what they thought would be a better location in San Bernardino, which is 50 miles east of LA. And they got a place that was big enough for 125 cars. It has 25 items on the menu, including slow-cooked barbecue beef and pork. But the business boomed. They did $200,000 in annual sales during the 1940s at this restaurant. They made enough money that they were able to buy the biggest house in town. It was a 25-room mansion set on a hill overlooking the restaurant. And famously, they both bought brand new Cadillacs every year. Now, you and I know how difficult it is to start a business from scratch, any business. It's doubly difficult to start a restaurant, because to start a restaurant requires both capital and labor. So they had a lot of capital tied up in buying the real estate and all the equipment. And then they had to have all these car hops. And there are dozens and dozens of car hops. Apparently, most of the people at the restaurant are playing grab ass with the car hops. And so they keep having lots of HR difficulties. Later, when they created their new version, they only hired men because the female employees caused them so much trouble.
Right, and they got rid of the car hops, which hurt them initially because all the customers expected to come and be served in their car.
But just imagine this. You've got a business. It's doing $200,000 a year in revenue. It's earning $50,000 for you and your brother, which is more money than anybody else is making in the 1940s. So what do? You shut the entire business down for 3 months. You rebuild the entire restaurant, and you come out with a new format that no one has ever seen before. So the kitchen grill went from 3 feet to 6 feet. The service windows were expanded to accommodate the customers walking up, not just the car hops. And the menu was cut from 25 items to only 9. The hamburger was shrunk. It went from 10 patties to a pound, from 8 to a pound. So they went down to 1/10 pound burgers. But the price was cut in half to 15 cents, down from 30 cents. And what I like so much about this is Much like Henry Ford, the McDonald's brothers didn't allow their customers to decide what they wanted because they knew the customers don't know what they want. So they served every burger the same exact way. It came with onions, pickles, ketchup, and mustard, with or without cheese. This allowed them to prepare the burgers and the cheeseburgers before they were ordered and was the whole revolution of what they called their speedy system. It was essentially the first time we'd really seen modern fast food. And it didn't work. Sales collapsed to only a fifth of the previous volume, and it didn't rebound until the brothers added one new menu item, French fries.
Right, they swapped out potato chips and introduced French fries.
When they introduced French fries, the volume immediately began to increase. By the 1950s, the restaurant was doing $350,000 a year, and the brothers were splitting $100,000 in profit.
You can imagine how busy that one unit must have been to generate $350,000
in 15-cent hamburger
and 10-cent bags of fries, probably a nickel for the soda.
What was really interesting about their original restaurant, and something we're going to see continues through McDonald's today, this restaurant existed on a third of the capital and a third of the labor of the average drive-in, and it was selling hamburgers for half price. So this is a business that has unusually small profit margins, but has unbelievable volume compared to the assets. And we put a little bit of leverage in that, and that becomes a very high return on equity business, which is what McDonald's is.
Right. And it may not look like a good business in the same way that Costco, for example, a super low margin business that has very thin margins, but very high asset turnover, inventory turnover, is in fact a fabulous business and can be almost impossible for any competitors to dislodge because it depends on super high volume. So if you're trying to start up and compete, how do you get that volume?
One of the things I think that's a myth is that the McDonald's brothers and the success of their speedy system was some kind of a secret that Ray Kroc discovered. The whole restaurant industry was well aware of what the McDonald's brothers were doing. Their restaurant was on the cover of American Restaurant Magazine in 1952, the year they started to sell franchises. Now, this is so interesting to me because just because you're really good at restaurants does not mean you know anything about business. And they didn't understand business or franchising at all. Their idea of selling a franchise was to take $1,000 and then to give somebody their manual. The first guy they sold to was Neil Fox. He was a restaurateur in Phoenix. And they were shocked that he wanted to use their name. They're like, what the heck are you using our name for? Our name doesn't mean anything in Phoenix. Why don't you call it Fox's? And he, of course, was very wise and was like, no way, man. I'm copying every single thing you guys are doing. The store in Phoenix became very iconic. They went to their local architect, Stanley Mesto, and they said, design a modern store for us because this is the 50s now. We've been doing this since the 30s. We want a modern look. And the guy built this mid-century classic design glass rectangle box, and he colored it garishly, white and red tiles, so it looked circus-like. And then famously, Dick McDonald drew the golden arches. Dick expected that the arches would be structural. They would be made of steel, and they would help support the roof and anchor the building. But Mesto wouldn't agree to draw them into the building. He hated them. And so the McDonald's brothers took the plans away from him and then went to a friend who was a sign maker, George Dexter. George made neon signs. So the golden arches were lit neon arches. They weren't structural. And of course, unbelievably important to the brand. Just fascinating that so many things in great businesses get discovered almost by accident. So Tilson, how would you like to be 54 years old and have been working at a startup for the last 4 years that has made essentially no money to the point that you have never been able to take a salary from it, and now you have to mortgage your house and borrow against your life insurance just to meet your payroll? And you realize about 5 years into the process that you don't even have a viable business model, and you're already up to your ears in debt, both at the corporate level and the personal level. This does not seem like the moment from whence great fortunes spring, but that is exactly where Ray Kroc found himself in the early months of 1960. Why don't you take us back to Ray Kroc?
Sure. So Ray Kroc was a traveling salesman selling milkshake machines that had a nice advantage relative to the technology at the time. A typical machine would make one milkshake at a time, and this had the circular design run by one motor. You could put 6 milkshakes all around and do it at once. And so he was traveling the country. And keep in mind, he was 51 years old at the time when he encountered McDonald's and met the McDonald's brothers. And his career, he was sort of a traveling salesman who had never achieved any kind of huge success. He had been a salesman for paper cups early in his career and a number of other things. And so he discovered that he got an order for 8 machines from one restaurant. And that was unheard of because a typical restaurant would just order one machine, could make 6 milkshakes simultaneously, and that was plenty for pretty much any restaurant in America. And so he was intrigued. Who are these McDonald's brothers ordering 8 machines from me? And he correctly surmised they must have a heck of a business. And he went out there and was blown away. And so he persuaded them to allow him to be a franchisee and start opening up McDonald's restaurants. Ray Kroc did a number of things that were brilliant, innovative, that got McDonald's launched on a trajectory. He was very aggressive in wanting to expand the concept. So I think, Neil Fox just went and built one restaurant in Phoenix. Ray Kroc was determined to grow it. He was very aggressive in doing so. He hired some great people early on who helped him understand, for example, that this was a real estate business.
We'll get to that. We're getting ahead of it. Let's go back to where Ray Kroc is a multi-mixer salesman.
Yeah.
Because there's a very important part of the story. I think the reason why McDonald's succeeded where Dairy Queen didn't, because remember, Dairy Queen was already out franchising by that point.
Right.
The people behind Dairy Queen wanted to make money on their franchisees, and Ray Kroc didn't. He desperately wanted the franchisees to succeed. The McDonald's brothers also were very modest. They demanded that Ray sell franchises for no more than $950 and that the franchise fee be less than 2%. So Ray Kroc had to build McDonald's Corporation by only getting 1.9% as a franchise fee, and half a point had to go to the McDonald's brothers. So he had to build this franchise system with only 1.4% of the revenues, which is extraordinary. That the franchise fee for a long time was 4%, and it just recently was increased to 5% today. So it's amazing that he was able to get his side of the business to work at all, because so much of the efforts were at first spent on making sure the franchisees were successful. I don't think that would have happened in any other situation except for the multi-mixer, because Kroc had the right to distribute multi-mixers across the United States. And his company, the first company he started, he walked out of the paper cup business, and I want to say it was 39, and set up Prince Castle Sales, which owned the rights to distribute the multi-mixer. Prince Castle was an ice cream shop in Chicago, and Ray had been selling them paper cups because he convinced them to make milkshakes. And so he got them into the milkshake business because he was trying to sell them paper cups. And the guy was a mechanical engineer and said, I can make a lot more milkshakes if I have a multi-mixer. So he built the multi-mixer. He was friends with Ray, who got him into the milkshake business. So Ray got the entire license for the country to sell these multi-mixers. And Prince Castle Sales, as a business, continued to support Ray while he was building McDonald's. He didn't take a salary from McDonald's until 1961. And at one point in the late 1950s, he had to mortgage his house and sell his life insurance as like a 54-year-old man at this point, because there is no money coming to him from the agreement he has with the McDonald's brothers because the franchise fees are so small. And that, of course, opens the door to Harry Sonborn and his incredible breakthrough that the only way to make money from this situation is if we applied a whole lot of leverage and we own the real estate.
Right. And that was partly a way to finance the growth of the business because you can borrow against real estate, et cetera, and create a lot of value. But also, very importantly, it gave the McDonald's Corporation an exceptional degree of control over its franchisees, which was critical in building a consistent brand and delivering a consistent product. So any customer anywhere in the country, to this day, anywhere in the world, knows that they're going to get a standard hamburger and fries. It's going to be the same no matter where. And so keep in mind, back in the day when this was happening, a typical franchise agreement would be someone would get a license for an entire region, the state of California, the West Coast of the United States. And so franchisees would have an unlimited ability to open up restaurants. And so these franchisees became very powerful, and they could, in many ways, sort of talk back to corporate headquarters and not do what corporate wanted them to do. Ray Kroc, by controlling the real estate and by only giving out franchisees one at a time, as opposed to these broad licenses, was able to implement his innovative ideas around everything related to the product, the brand, pricing, etc. To this day, McDonald's has a lot of control over its franchisees, and that's been a critical element as well.
There's all kinds of really legendary stories about Ray Kroc and his dedication to his vision of what every McDonald's should be. And I think a lot of people misunderstand the advantages of this. If there are no rules about what you can serve in your McDonald's, then your creativity as an entrepreneur is going to go into maximizing that menu, making your place perfect for your little environment, and you're going to lose the ability of the continuity across the system. But if all of the system things are set in stone, now your entrepreneurial creativity has to go into things that can improve the whole system. And so by locking in everybody to exactly the same system, Ray unlocked a really big secret to this business, which is, as you mentioned earlier, the franchisees themselves then were the key to improving the system itself. Even though Ray insisted on continuity across the system, he was very open to suggestions from anybody on how to improve it. He also famously, quote, never forgot and never forgave. If you crossed him, you would never get another franchise ever again, and your franchise would not be renewed. In the very beginning of McDonald's, the very first franchisee who hit it out of the park was a guy named Sandy Agate. And Sandy Agate had the McDonald's franchise in Waukegan, Illinois. He lived directly behind his unit, and he was there every morning at 6 o'clock and worked every night until 11 o'clock and was the quintessential McDonald's owner-operator. And as a result, his store did $250,000 in revenue in his very first year. And they used to hand out the financials from that McDonald's location when they were selling franchises to everybody else. You know, it's obviously their most extraordinary unit, and they're sort of passing it off as average. But Sandy was an important partner for Ray for many years. And then he made a mistake. The local Pepsi distributor offered him the sun and the moon and the stars to put Pepsi in his McDonald's instead of Coke, and he took the deal. And as a result, Sandy never, ever got another McDonald's franchise. And in 1975, McDonald's refused to renew his license, and he was out of the system. Likewise, Kroc sold 18 franchises to his friends from his country club, the Rolling Green Country Club. And they didn't work very hard because they were all wealthy and mostly retired. So their stores didn't perform very well. And as a result, only 5 of them ever got another McDonald's franchise. And only one of the 18 went on to any significant success in the system, Phil and Vern Vineyard. And they were successful because they were poor, hardworking accountants, and they worked in their units. They went on to have 21 different franchises in Florida. But I loved what I was reading behind the arches, and there was a senior executive at McDonald's who got fired for one reason or another, and he had started some trouble for Ray, basically. And when he got fired, he was all surprised about it, and his wife said in the press that it's Ray's company, and Ray never forgets and he never forgives. And I can imagine it's pretty tough working in an environment like that. But if you accept the ground rules, a lot can be accomplished. And you see this in really determined entrepreneurs quite frequently. They have a vision of what the business could be, and they're pushing into that vision. And they're willing to make things better, but only if it matches their vision.
Right. And they can be very harsh. And the biographies written about them can make them look like
Steve Jobs.
Yeah. Bill Gates, Elon Musk, Jim Senegal at Costco, Warren Buffett at Berkshire Hathaway, Reed Hastings at Netflix. Mm-hmm. And they're always smart enough to surround themselves with some exceptional people. And they're focused like a laser on having across the organization only A players. But you better have the right person in charge. They'd better be willing to surround themselves with A players who will challenge them and who will and be willing to change their mind and listen to the ideas percolating up from below. But at the end of the day, it's not a democracy. It's a dictatorship of one. And that's how McDonald's and basically every great business I can think of was built.
I think the key is that the founders understand the value proposition to the customer better than anyone else because it's something that they have an intuitive, emotional feeling for. Think about the $1.50 hot dog and a Coke at Costco. Jim Sinegal understands what that means to the customer. It's not about a hot dog and a Coke. It's about the feeling you get when you can enjoy something that simple and that pleasurable, and it becomes part of your routine and your visit to the store.
It's part of the brand. And
it's absolutely part of the brand.
Yeah.
But it's about triggering that emotional bond with the customer.
Yeah, it's a signal to them that we here at Costco are about the basics at a better price than you can find. You will never see a lower price for something we're selling anywhere else. And when you walk in the door and you see the little food court there and the price that's the same as it's been for 30, 40 years, that's
a commitment to that.
That is. And even if it becomes a lost leader for them, doesn't matter.
Doesn't matter.
You got to keep that.
You think about Jeff Bezos. He understood more than anyone ever before, and probably even today, that what the customer wants is unlimited selection and immediate delivery. Everything should be and needed to be risked to drive that value proposition more completely and more thoroughly than anyone else. And they did. They put the entire company at risk in 2000, 2001. They famously borrowed $2 billion or something to build out all the warehouses to make this happen, and could have easily gone bankrupt. But Jeff knew someone is going to do this, and it had better be us, because whoever gets there first will be the winner. Think about Fred Smith at FedEx. Overnight packaging with air freight is now possible, and that is what we do. Costco, you've talked about price, Amazon, selection and delivery. So what lies at the heart of the McDonald's magic? And I think that this was what Ray Kroc figured out better than anybody is, number one, we need to be on every corner as fast as we can, because the best real estate in every town is only going to be available once. And once it's built out, it'll be very difficult to acquire. The second thing is, and this is really unique. Somehow Ray Kroc figured out, or maybe it was the McDonald's brothers figured out, that if your store was clean enough, safe enough, and friendly enough, people will let their children walk up to order. And by doing so, children got their first experience of doing something that was adult-like. And for kids, that's a magical moment to realize that, oh, I can go and order at the counter and get my food and my drink and my French fries. And if you go to McDonald's and you watch kids doing that for the first time, you see that magic happening. And that's one of the reasons why McDonald's has done things like put playgrounds in the restaurants, because if you get a love for that French fry and that Coke and that burger when you're 7 years old, it won't ever leave you. Kind of like the hot dog at Costco, there is something that hits the emotional buttons in your brain that make you feel safe and happy when you eat that food. And that is a link that nobody can describe, but everyone has felt if they had those experiences when they were kids. And Ray Kroc understood that. So he made sure that those restaurants were always super clean, always super safe, always super friendly, and always welcome kids. That is a huge part of that secret.
Right. And then you combine always tasty food, it's consistent, and critically,
it's affordable.
It's great value.
Yep.
I mean, look, this discussion reminds me of how Charlie Munger once outlined Coca-Cola over 100 years. He started with the premise that every human being on Earth needs to consume a certain number of ounces of liquid a day. And the default is, of course, water, but you're providing something that is necessary for humans to survive. So it's one of the world's biggest markets that you're entering into, serving a fundamental human need. And you could make the exact same arguments about McDonald's.
When I learned more about Ray Kroc, I was just so fascinated that he spent time in Miami, because I've lived in Miami Beach for 20 years. Miami is still the place where if you make a lot of money in the Midwest, you go and you buy a fancy second home. And there's a lot of people in the Midwest have fancy homes in Miami Beach, always have, from the industrialists back at the last century to this very day. Anyways, I was fascinated that he was such a hustler that when the land boom was going on in 1925 and 1926, he went down to Miami to sell real estate. And to make ends meet, he played piano in a speakeasy that was on Palm Island. And he got arrested when they all got busted by the federales. And I think it's really fascinating, the idea that Ray Kroc was a convict at a point in his life. I also thought it was fascinating that he dropped out of high school when he was a sophomore, and he volunteered to go drive ambulances in World War I, which is the same thing that Hemingway did and the same thing that Walt Disney did. And you think about the role that McDonald's played in California's economy post-World War II and Walt Disney. It's just so fascinating that they were in the same ambulance troop during World War I. It's also just fascinating to think about how long McDonald's has been around and how much of the modern world that Ray Kroc and McDonald's helped create.
Yes. Interesting you mentioned Disney there. The early days of McDonald's happened to be the early days of Walt Disney building Disneyland and Ray Kroc. They had met at some conference years earlier, and Ray Kroc wrote to Walt Disney proposing that they have a McDonald's restaurant in Disneyland. According to the McDonald's side of the story, Walt Disney was open to it but wanted to charge 15 cents, not 10 cents for a bag of fries. And Ray Kroc wasn't willing to gouge his customers and said no, and the deal fell apart. There's no evidence for that apocryphal story. It was probably the deal fell apart for other reasons, but I suppose the reason the story exists is because one of the things that defined Ray Kroc was determination to keep costs low, to keep prices low, to deliver value to customers, and to make it up in volume, basically, which is stories you hear about Jim Senegal, the founder of Costco, that kind of maniacal focus.
Jeff Bezos of Amazon as well.
Those stories only arise about those type of people because it's rooted in the truth, whether or not the apocryphal story is true or not. One other point I just want to make about raising prices and the $1.50 at Costco and all. I remember reading in Ray Kroc's autobiography the anguish that when, over, 10 years or so, they became known for their 15-cent hamburger, but inflation over time had made that impossible. And so they needed to raise prices. And they're like, look, if we're going to have to bump our price, let's just bump it to a nice round 20 cents. And he fought that and said, no, I think we can make a go of it at 18 cents. They did bump the price up after decades, going back even prior to Ray Kroc, to the McDonald's brothers. It was always 15 cents. And that was hard. It was risky. They had no choice. They delayed doing that as long as they could. And it eventually worked out beautifully. And it demonstrated that the company was delivering so much value that they could raise prices a little bit in this case, or 20%. And the company still has pricing power to this day.
Enormous pricing power.
Exactly.
Yeah.
Because they deliver so much value.
For now, I want to go back and I want people to understand how close McDonald's came to never happening, because the McDonald's brothers had already failed once to sell franchises. They started in 1952. They sold 15 of them. None of them ever really went anywhere because they weren't doing anything for the franchises except for giving them a manual. Ray Kroc, on the other hand, made his entire life about making sure that these people succeeded. And that happened because he was selling them multi-mixers. So if he hadn't been the Prince Castle sales guy, he would not have had a business model that could have allowed him to sell franchises cheaply enough for them to grow fast. He wouldn't have been able to survive. And that was the case. And this was a quote of his in 1961. It was life or death for me. If I lost out in McDonald's, I'd have no place to go. Mortgaged his house, had everything 100% committed to making McDonald's work. And one of the reasons why they couldn't get any loans is because it wasn't making any money. McDonald's didn't make any money for a long time. They started franchising with Ray Kroc in 1955. By the beginning of 1958, McDonald's had a net worth of only $24,000. It had earned $26,000 the year before, but most of that was in one-time licensing fees that were charged to the new franchises. The year before, in 1957, it lost $7,000. The beginning of 1958, McDonald's only had 34 locations and had no control over the real estate at any of those sites. The company was planning to add 50 stores in 1958, and it had a plan, either through lease or outright ownership, to control the real estate at all of those new locations. That amounted, lease and purchase, to $3.5 million worth of real estate that they were planning to buy in 1958 from a base of $25,000 and no real profits to speak of. What are the odds that gets done in 1958? $3.5 million is an enormous fortune back then. And they've got absolutely no collateral. So this story, 1958 is when McDonald's really happens. And how it happens is just unbelievable genius and also some pretty significant accounting trickery. Harry Sonborn is McDonald's real estate guy. And he figures out that Ray Kroc isn't really in the burger business. He's in the real estate business. He just doesn't know it. So what Sonborn manages to do is to convince real estate owners to lease McDonald's, the site for the restaurants, and then mortgage the same property to build the building for McDonald's.
Right. Keep in mind, this is McDonald's Corporation in these transactions, not the actual restaurant operators.
Right. In fact, originally it was called Real Estate Leasing Corp or something like that. It wasn't even called McDonald's at first. The property owner had to give up the first lien to McDonald's. Let me get this straight. You're going to lease my property from me, and if you default, I don't get to keep the building because I also had to give that right to the bank. So what? It's like a game of smoke and mirrors.
Right. And I wouldn't call it accounting trickery or anything. It was simply demanding that the people who owned the land, he had to persuade them to do something that they probably wouldn't normally do, because you don't lease your land to somebody and then allow them to borrow against it to put a building on it, and then you're subordinate to the lender for the building, right? It was risky for the landowners, but Ray Kroc and Harry Sonborn were good salespeople. And by the way, they were able to show a concept that the landowners believed in and looked to be successful.
But they did all that by lying about the numbers. Sonborn admits when you're trying to sell something like that, a real estate deal, you need a really good financial statement. And the Des Plaines store's statement, quote, wasn't that good. So I understated expenses and overstated profits. He basically admits to accounting fraud. And the other thing, of course, they did was that when they had the Waukegan store set up, they were like, oh, yes, this is all very normal. And of course, it was exceptional. So there was a little bit of hoodwinking going on.
Yes, I can imagine that had they defaulted on some of this, the landowners might have had a good case in court
for sure
that you deceived us and therefore we shouldn't be subordinate or something like that. But of course, McDonald's was successful and they never defaulted. And I guess we'll never know the answer to that. This is a theme you and I have discussed often about how some of the most successful companies in the world at one point or another during its early days, cash-starved days, or during a time of crisis, practiced, let's just say, very aggressive, if not outright fraudulent accounting in order to survive.
This is how they get started. They get landowners to agree to the double jeopardy situation, and they're using sort of fudge numbers to prove that the store is going to afford these expensive leases and the mortgage payments. And then they turn around and they get franchisees to operate the restaurants and make all the payments for them. The result of all that is over time, McDonald's is going to end up with a lot of very valuable real estate as long as the restaurants are producing. So that they start that process. And the reason why the local banks went along with it was because McDonald's was paying about 2 points more than anybody else. And by that time, they had a good reputation. Everyone else is doing these deals. And so it becomes very normal, the idea that McDonald's is borrowing a whole ton of money from the bank and from the landowner, and the franchisee is paying for all of it.
Yeah, this was the early days of sort of high yield credit, because normally banks back in those days wouldn't lend to any sort of dicey, unprofitable company like this.
But still, McDonald's really isn't generating any money. They really need to get some real institutional capital so they can get better terms, so they can continue expanding. So in 1960, Sonborn starts talking with some big insurance companies, John Hancock, the State Mutual Life Insurance, and Paul Revere. And they put together this incredible financing package where they're going to loan McDonald's Corporation $1.5 million. And they're going to get, I think this was a 7% loan, which was a lot of interest back then. And they're also going to get, the insurance company is going to get 22.5% of McDonald's Corporation stock. But think about what a risky loan this was. The size of the loan was 15 times greater than McDonald's net worth at the end of 59. So this is really the beginning of high yield finance for McDonald's. They did the deal, and when McDonald's went public a few years later, they made an absolute home run. That $1.5 million loan ended up making those insurance companies something like $30 million in profit.
Right, because they got stock.
They got 22.5% of the company.
Right, and had they held it, of course,
it'd be worth a fortune today. But that was an interesting thing. A lot of the other fast food businesses at the time that were involved in the same rush to the suburbs that McDonald's was, most of them ended up selling to major institutions. Burger King sold out to Pillsbury, and Burger Chef was sold to General Foods. Famously, Pizza Hut and Taco Bell were sold to PepsiCo. But McDonald's, because of this insurance money, was able to maintain its independence. And I think that's another reason why it has become such an iconic franchise, because it's always been in control of its own destiny. It has never had to have a corporate master. It's amazing that even though McDonald's was growing very fast, and even though it had huge revenues, McDonald's Corporation didn't begin to make any money for a long time because it was spending all of its cash flows on interest to buy more real estate. It wasn't even paying Ray Kroc a salary. And in 1960, it only made $77,000, which was less than the $100,000 the McDonald's brothers were making on one restaurant in San Bernardino. It's fascinating how much equity value that they were building, but not in terms of cash. And this is something that I've had a really hard time learning as an investor. I was always so conservative. I always wanted to see the cash earnings. But in our lifetimes, we have watched people like Amazon build enormously valuable businesses that never had any cash earnings. And so that has opened my eyes to the idea that if you have a really good business, there's nothing at all wrong with not having any cash flow, as long as those earnings are being plowed back into building a better and faster growing business. All right, Tilson, we're now back in 1961. You're Ray Kroc. You're leveraged up to your eyeballs in this McDonald's business. You've taken your first $1.5 million in institutional money that's allowed you to start paying yourself a salary, and you're continuing to plow all the company's profits and earnings back into more restaurants. But you've got to get rid of the McDonald's brothers, or you're never going to have any chance to do what needs to be done to make the business work, like renegotiate the franchise agreements, because the brothers won't agree to any changes whatsoever. So if you can't get the brothers out of the deal and they maintain control over the franchise agreements, you're stuck. So you send them a blank check and you say, what's it going to cost to get you guys out of the deal? And the brothers, in a way, they're really sweet. They're like, no, if we could have $1 million each after taxes, that's more money than we could ever use or need. And they didn't have any children. And they, as they said plainly, we didn't want to leave our money to the church. It was a good enough deal for them. But where's Ray Kroc going to get $2.7 million to pay the brothers what they want to walk away from the deal? It's just inconceivable. They've leveraged everything 2 or 3 times already. They've got phony accounting that's at the root of the expansion. And so what did they do? They go back out to the Eastern money people and they tap into the endowment funds of the Ivy League colleges. I bet nobody knows that it was the endowment of Syracuse, Princeton, Swarthmore, and Colby that coughs up the $2.7 million to buy the McDonald's brothers out of McDonald's. The way they structured this deal was just extraordinary. The high yield market didn't exist yet, and McDonald's couldn't afford a high yield loan. So how is this going to work? How, if you're a really fast growing company, how can you afford this loan? They agreed that McDonald's would borrow $2.7 million at 6% interest and pay off the loan with monthly payments equal to 5% of the restaurant chain's total food sales. And that was the same amount that McDonald's is already paying each month in royalties to the McDonald's brothers. Basically, instead of paying the McDonald's brothers, you're going to pay back the money you need to get them out of the deal. Here's the cool thing, though. The length of time it took McDonald's to pay off the entire principal and interest would then determine the length of a bonus period in which McDonald's would make additional monthly payments to the lenders as an incentive for making the loan. In this case, the high yield part of this loan was not the rate, but the duration. So as many months as it took for them to pay off the loan, that many months that would follow, they'd have to continue paying. It's a fascinating idea, I think, of financing an acquisition. There was one other trick to it, which was if McDonald's needed to, it could defer 20% of the payments during the loan repayment period, but then that would all have to be paid again through a third bonus period that would begin when the first loan was completed. So in other words, if McDonald's got into a tight spot, it could defer 20% of its payments, but anything it deferred would then create a third bonus period where it'd have to repeat those payments at the end of the loan. Really ingenious kind of financing. And there's a story, of course, that even after they thought they had everything sewn up for the note and Sonborn had gone off to celebrate with a trip to Vegas, the lenders called him at the last minute and said, nah, we're not going to do it. And so he had to fly back to New York overnight and convince them that they were in the real estate business, not the hamburger business, and that everything would be repaid. Anyways, when the whole loan was finally repaid, the Ivy League colleges got back $14 million. That is a very high financing cost. Mm-hmm. And it's just fascinating how much capital McDonald's was willing to put into this business to make it work and how much risk they took.
Yeah, it's also, when I look back at that, I was like, oh, why didn't they just call up a venture capitalist or angel investors or something like that? It didn't exist. And it's something that anyone who's grown up in today's modern markets, I'd argue at least the last 25 years or so since the internet boom and all, one of the things that makes the United States such a vibrant and powerful economy and why our growth rate has exceeded that of most other Western countries has been the explosion since these days we're looking at 60, 70 years ago in all sorts of capital, debt, equity, hybrid type of things, where imagine someone today with an idea and a concept like Ray Kroc, even crappy ideas, something like Sweet Greens or something like that, can get funded through multiple rounds. And yeah, it's high risk, but it's also been collectively super high return. And this does not exist even to this day in most of the rest of the world, or to the extent any foreign company, often they're getting financed by the U.S. system since there are a lot of internationally focused venture capital funds. The very interesting structure you've laid out here today is routine. But back then, it was very innovative, unusual.
What occurs to me about this, and I want to go back just for a second to accounting fraud issues. What occurs to me about all this is to create a really fantastic business usually requires an unbelievable amount of capital. An amount of capital that is so large, it would be virtually impossible to get anyone to put up the money. Think about how much money Tesla was going to need to be successful from 2004, when Elon got involved with it, till today. A massive amount of capital. And the fact that he was able to raise it, maybe through hook or crook, is definitely largely responsible for the success that has then occurred. Of course, you also had to have a mad genius at the helm who was going to design cars like this that people would fall in love with and the software systems. But the capital is absolutely paramount.
Right. He did it again with SpaceX. I just saw its private valuation
$210 billion,
over $200 billion, and it's still losing money. It's been losing money forever and ever. It has almost gone bankrupt multiple times.
But people see the equity value in it despite the lack of cash.
You bet.
And I'm sure there's a way for us to go back and figure out exactly how much capital McDonald's consumed between 1955 and 65 when it went public. But it's the amount of capital today is hard to even imagine because the GDP is so much smaller. It's more than just a conversion of the inflation rate. But this is an enormous amount of capital, and it's all sort of being raised in almost a pyramid-like structure. Where everyone's getting promised that, yes, we've got earnings, and yes, we've got title, and yes, we'll pay you over time. It's all getting pushed out and levered. Let's talk about a couple of other things that has made McDonald's such a success over the years. One, we've talked about how creative they were with getting capital. Two, we've talked about their unusual dedication to the customer experience in terms of the value proposition, the cleanliness and friendliness of the restaurants. But let's talk for a minute about the way they have encouraged and enabled both their franchisees and their suppliers to succeed. And this is one thing that Ray's background as a salesman, I think, was really consequential towards. If you're a good salesman, you know that if you can solve your customer's business problem, he will buy more of your product. Good salesmen solve problems. Ray Kroc constantly was helping his franchisees solve problems.
You look at McDonald's history, many, the Big Mac, the whole idea of a breakfast menu, things like that were dreamed up by the CEO. They came from organically.
Yep. The Egg McMuffin, the filet of fish, and let's go to the filet of fish. So this was the Cleveland franchisee where there was a large Catholic community and they wouldn't eat beef on Fridays. And so on Fridays, McDonald's isn't doing any business. So the guy starts buying halibut from Canada and serving it on Fridays as the filet of fish. And it booms. It's the best performing franchises in the whole system. Now everybody wants to sell fish on Fridays. And they go to Groton's, the fish company, and they say, you got to help us figure out how we can distribute halibut to all the people. And the guys are immediately like, well, that won't work. Halibut you can't freeze it, blah, 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 blah. And the other problem was they had to invent a new way of getting the breading to stick on it when you were going to freeze it to distribute it. But they get all these problems solved, and Groton's becomes their major fish supplier. And the investment that Groton's makes with McDonald's and R&D leads to a lot of success, both for the supplier and for the franchisees.
Right. Happened in potatoes too, right? And many other things. McDonald's really the partnerships with its suppliers.
The potato story is even more consequential. And I think it goes to the role that McDonald's has played in the entire economy. You guys probably already know the story, but there was a guy, Jack Simplot, who was a leading Idaho potato farmer, and he really wanted to help McDonald's solve a core problem they were having with their French fry quality, because there were about 3 months out of the year during the summer when russet potatoes were not in season, and McDonald's had to use California white potatoes, which weren't nearly as good. J.R. Simplot volunteered to spend $400,000 of his own money, and he put 300 train-load cars of russets into cold storage around the United States so that McDonald's could be supplied year-round with his russet potatoes. Unfortunately, it was impossible to control the storage of 300 carloads of potatoes in dozens of different locations, and almost all of them ended up spoiling. So Simplot took a huge hit, but it got him thinking about how to make frozen French fries that could have high quality and be controlled. And by the way, everybody at McDonald's was against this because fresh French fries was the hallmark of their business. They knew how important it was to it. But they said, if you want to invest in this, Simplot, we'll work with you on it. And so he invested $3.5 million building out a frozen French fry production line, and McDonald's invested with him in the R&D. The patent was actually belonged to McDonald's, and Simplot didn't even demand a exclusive license to the patent. He said, if I can't make the best potatoes for you, then you guys should have us a separate supplier. So he and Ray, on a handshake, built out an enormous new production facility, enormous brew production line that by 1972, every single French fry served at McDonald's had been produced and made by Jack Simplot. That's 600 million pounds of French fries. And they kept working on the system until everybody agreed that the frozen French fries tasted better than the fresh French fries. And then it allowed them to have uniform distribution standards. Even today, Simplot still supplies half of McDonald's fries and has revenues of about $6 billion a year. Now, what's this got to do with the American economy? Simplot took the profits he made selling French fries, and he helped build a company called Micron Technologies, which has been a absolutely key innovator and solid state, meaning microchip-based memory systems. And those supplies today are absolutely integral to the new data centers that are being built by NVIDIA and their other partners. So it's pretty amazing, isn't it? You do a better job of making hamburgers and fries, and next thing you know, you've got venture capital for high tech in your economy.
Yep. Again, something that where successful entrepreneurs in one area seed entrepreneurs, usually in the same sector. It's most common in the tech sector, but in this case, in a completely different sector. There's sort of an ethos and a culture in American business that's very powerful and not completely unique, but probably practiced best here in the U.S.
Are there anything from the past, from the McDonald's brothers, from Ray Kroc's story that we're missing, that we need to touch on to understand the unique franchise history in the context of what makes McDonald's special as a business?
I was looking through my notes about the history, and in 1962 and 1963, that's when McDonald's launched two of its most recognizable logos, the golden double arches that we talked about earlier, but also Ronald McDonald. And I believe it was a franchisee who dressed some guy up.
Some guy. It was the guy who did the weather on NBC for 30, 40 years. Willard Scott was working as a clown for a local television station. And when his program got canceled, remember Bozo the Clown?
Right.
It was a Bozo the Clown kind of knockoff, but it was done by local television. And Willard Scott played the clown. When they canceled the show, McDonald's had been a primary sponsor of the show. And so McDonald's went to Willard and said, we still need a clown. Come be a clown in our TV ads. And that's how Ronald McDonald was born.
Yeah, debuted in 1963 on 3 separate local television spots, and actually it was an advertising agency, a guy named Oscar Goldstein, who created it for the franchisees in Washington, D.C., and they hired Willard Scott, who was an employee of Goldstein at the time. And it wasn't just that one character, but now there's the whole world of McDonald land with Mayor McCheese, the Hamburglar, Grimace, Birdie, the Early Bird, and the Fry Kids. Again, all this sort of innovation and brand building and creating this sort of wholesome family atmosphere. And then while you were asking about, other key things, I was looking at the history here and McDonald's international expansion.
Let's start in Boulder, Colorado, before we get to international. In 1998, the board of McDonald's was trying to find ways of reinvesting their capital at attractive rates in the restaurant industry. And they funded a couple of new restaurant concepts, the names of which aren't important because none of them really worked. But through a friend of a friend, a college kid who has started a little burrito shop in Boulder, Colorado, got invited to the boardroom of McDonald's to make them a burrito. This guy was a classically trained chef. He'd been a sous chef at the finest restaurant in San Francisco. He, on a lark, had started a burrito chain. And I think at the time he had maybe 6 locations in Boulder. He goes to Chicago. He makes his burritos for the board of McDonald's, and they love it. So they end up buying his business. They did so in tranches and steps over time. But by the time Chipotle goes public, in 2006, McDonald's owns 90% of it. And when you were buying McDonald's for your fund back in 2003, I'm willing to bet that you either didn't even know about Chipotle or had no idea what it was worth, or certainly had no idea of what it was going to become worth.
I wasn't aware of it initially. I did become aware of it because a McDonald's franchisee who told me what all the incredible turnaround that was going on that got me excited about the stock. He later told me, hey, this Chipotle thing's really got legs, and McDonald's franchisees are scrambling to get the franchise to open up Chipotle's. And I wish I'd paid attention, and I remember looking at it when it went public in 2006. It was trading at 50 times earnings at the time, and I was too much of an old school value investor to understand, well, that's because just like McDonald's decades earlier, the earnings are depressed by the fact that it's investing heavily in growth. And of course, what I missed is even if it really was trading at 50 times earnings, it was off such a small base, and this thing was a great concept, had room to run, et cetera. So, one of the biggest mistakes that I made much more frequently earlier in my career, for sure, is being more focused on the current valuation multiple, whatever multiple of revenue, book, or usually I was using earnings, as opposed to thinking broadly, how good a business is this and how big could it be in 5 or 10
What's it going to be worth in 5 or 10 years? Yeah.
And getting the answer to that question right is 10 times more important than whatever current valuation multiple you're looking at.
Yeah, but also very difficult to get right, or even close to right.
Yes. If you are investing in early stage, higher valued stuff that, I don't know what the valuation was early on, but I remember when I was buying Netflix at the bottom, it had a $3 billion market cap. If you invest in a basket of those, maybe only a few hit, but those that hit where you make 10 to 50 times your money means nothing else matters as long as you're clever enough to hold on.
The two things about the Chipotle scenario are important in my mind, and that is, number one, most of the time, investors don't do a good enough job. When I say investors, I mean you and me. Most of the time, people who really should understand what these other businesses are worth or could be worth inside a company, they just get ignored. And that's why spinoffs typically do very well, because most of the time, investors aren't paying attention to the other businesses that are inside a listed company. And it's not until they're spun off separately that they really garner the value and the attention that they deserve. The other thing that is so interesting to me is McDonald's should have never sold Chipotle. And I know why they did, because if you look at any business, there's really three ways you can earn your return on equity. You can earn your return on equity with profit margin. You can earn your return on equity by having a high asset turn. So in other words, having low assets compared to sales, and you can earn your return on equity with leverage. McDonald's has always been a leverage story and an asset turn story. It's never had big profit margins. So what McDonald's has done through their franchising system is they have gotten rid of the asset base because they use their franchisees' assets, and they've applied a lot of leverage. So the way that the McDonald's Corporation looks on this metric is very high profit margins, no asset base because they're borrowing all the assets, and leverage, which is an extraordinary return on equity, which is how you get to 25% a year return on equity. But when you're looking at the actual restaurant concept itself, how does a McDonald's location make money? A McDonald's location makes money by having very small profit margins and having very high turn on assets and having leverage. That's the formula. Chipotle had such a different formula. Their formula is very big margins. They have great margins and they have tremendous volume and very low leverage.
Right.
And those mindsets did not align. And I've heard that the breaking point was that Chipotle refused to put in a drive-through in its stores. I know some of the Chipotle people, and they really see themselves culturally as a restaurant, not as a fast food location. Very different culture, very different mindsets, very different business models. So I'm not surprised that McDonald's spun it out.
And Chipotle doesn't franchise, right?
No.
In order to make their margins, they need to do it at the restaurant level.
Just imagine the possibilities. I suspect that if McDonald's didn't spin it out, they would have franchised it. Lots of things could have gone wrong. It would have become the Mexican version of McDonald's over time. And I don't think it would have worked, because there is something very special about going to a Chipotle. It's more like going to a restaurant. And the food isn't very good if you take it out, because the corn tortillas and everything else, it doesn't age well. You have to eat it fresh.
Right. If you look at Jack in the Box, Wendy's, other restaurant, McDonald's competitors, it became a thing to have your own Mexican fast food chain. Qdoba is one of them, and they
Baja Fresh.
Yeah, Baja Fresh is another. I forget which,
but none of them were Chipotle,
and none of them have particularly done well.
So I think it's likely that if McDonald's hadn't spun it out, they probably would have broken it. So it's probably best that they did. But I can't help but wonder, what if they had just left it alone?
Now, keep in mind, McDonald's shareholders got shares in Chipotle when they spun it out, and so McDonald's shareholders could have just held on to it.
So what is Chipotle's market capitalization right now?
$91 billion.
And what's McDonald's?
Double that, 186.
So in other words, McDonald's could be 50% bigger today if it had held on to Chipotle.
Yes.
And the other thing,
keep in mind, the shareholders, as you've correctly pointed out, that $91 billion, only a fraction of that would exist in all likelihood.
I agree.
Spun it out, and shareholders could have just kept both.
They could have held both. I'm bringing this up because McDonald's continues to pay out more than they're earning in free cash flow. And they can afford to do so because they're growing the business, and they're keeping leverage fixed as a percentage of the growth of the business. So even though it's a little bit of a money puzzle, it does make sense. It is sustainable.
Yes.
But as a shareholder, I wish they wouldn't. I wish they would continue to seed new startups, because in my mental model of how the market works, and by this I mean the stock market, it is a power law distribution. Some things like Chipotle end up garnering all of the value. McDonald's, as people who are experts in food and in restaurants, they should have the ability to have a venture capital arm that is trying to build the next whatever it is, Chipotle, the next Domino's, the next power law winner. I know that 9 out of 10 of them will fail, and I know that only maybe 1 in 100 will become a power law winner. But who better to do that thing than McDonald's? And you could also have them do not just restaurant startups, but you could have them do food equipment. And listen, I know the danger of this, right? You get the wrong board in, you get the wrong CEO, and next thing you know, you're buying vineyards in Romania like Coca-Cola did.
Mark Zuckerberg pissing away untold tens of billions of dollars on the metaverse.
Exactly. I'm not saying that public companies are great investors. I'm just saying that as a shareholder, I'd take 10% of those dividends and let you try to figure out what the next big thing in food is going to be.
Mm-hmm.
And you should probably have a team of really woke hipster dudes in London and New York and San Francisco who are keeping their nose to the ground and sniffing out the next classically trained chef who cooks a burrito. And if we don't want McDonald's to buy restaurant chains, which hasn't worked out, they bought Donatello's, it didn't go anywhere. They bought Pret a Manger, it didn't go anywhere. And we recognize there's a danger in them running something like Chipotle because they might not understand that secret core emotion that's linking the business to the customer. What could they do instead of returning the capital to shareholders?
I'm not sure I agree with you that I want McDonald's doing a lot of this. I mean, maybe a little bit of it at the margin, seeding some new ideas. They generate almost $10 billion a year in operating cash flow.
That's because it's rent.
Right. How much of that?
It's literally rent. They get $10 billion a year.
That would I allocate to their sort of internal?
How about $100 million?
100 million. That's the number that popped into my mind.
Yeah.
1% of your operating cash flow. And $100 million is still,
that's a lot of money.
You might spin out and validate it externally by, if they need capital to grow, don't just write an open check like Google has spent untold amounts of money on Waymo, develop some cool technology. But I sense there's been no external market discipline on the amount of money they've spent because Google just generates so much cash, Alphabet now, that Waymo has gone through a lot more cash than it otherwise would have. So I think you need to structure the incentives right and make sure that it doesn't turn into a lot more money. But look, McDonald's, I still think it's clearly now a cash cow business, but it's still got room to grow. It's a big world out there.
We talked about how through the franchisee, they discovered the filet of fish. McDonald's in the early 1980s noticed, like everybody else did, that people are moving away from beef and eating more and more chicken. And so they're trying to figure out how to put chicken on their menu. They can't do fried chicken better than Kentucky Fried Chicken's doing it, so they don't want to go that way. Instead, Ray Kroc hires a 5-star continental chef from the fanciest restaurant in Chicago. And Fred Turner, who's the former
Rene Arend, native of Luxembourg.
Yep. Rene Arend. And Fred Turner is irate. Fred's the chairman, and he is a former burger flipper. And I think he's got a chip on his shoulder about the fact that McDonald's doesn't need no fancy French chef in here kind of thing. And originally, Ray Kroc has tasked him with trying to figure out how to bring chicken into the menu, and his first attempts are failures. And then Ray gets the idea, we're going to sell onion McNuggets. The fancy continental chef fries the onions, but there's no way to do the quality control. Some of them come out terrible. Some of them come out good. It's not going to work. So on a lark, Fred Turner says, why don't you try that with chicken? And so the chef goes back, cuts chicken into squares, and they all love them. But now they don't know how to scale. And there's a big issue because there was no machine that could debone chicken. And so they get with their suppliers, and one of their meat suppliers comes up with an idea of using a hamburger-like metal tool to cut the chunks of chicken. And then their chicken supplier builds a whole new assembly line to debone chicken by hand at scale. And they come up with the chicken McNuggets. The result was just phenomenal. Within 3 years of the national introduction, the bite-sized nuggets...
Just to put the dates on this, They were launched in select markets in 1981, then rolled out more broadly in 83, but they encountered all sorts of supply issues that took a few years to resolve because they were so popular.
This is 1985. The king of the hamburger business is selling McNuggets at scale, and they account for 7.5% of McDonald's domestic sales. That's $700 million in nugget sales in 1985, thus making McDonald's the world's second largest chicken retailer in the world behind Kentucky Fried Chicken. I just think that just speaks so wonderfully to the unique power of what McDonald's is. Kentucky Fried Chicken, that's a chicken business. Domino's Pizza, That's a pizza business. McDonald's, that's a hamburger and a French fry and a milkshake business. No, it's not. No, it's not. It's a food that makes you feel good and that makes your kids feel good restaurant. That's what it is. And nobody can tell you what part of the chicken a nugget comes from, although McDonald's did over time introduce all white chicken meat nuggets. But nobody cares. Nobody also can tell you what part of the pig the McRib comes from. But nobody cares because it tastes good and it's cheap and it makes you feel good.
Should we talk a little bit about international and what they've done there? It was only a couple years after they started expanding internationally that they launched breakfast, which now accounts for a quarter of McDonald's sales.
Breakfast is a big issue, so we're going to come back to that. What I wanted to say is investors are missing something really important about McDonald's right now, like they missed Chipotle back in the early 2000s. And that is McDonald's does not own McDonald's China. Horrifically and stupidly, McDonald's divested McDonald's China, and they brought in a U.S. private equity firm and a big Chinese investment bank, CITIC, to own 80% of it. And of course, that's the fastest growing chain in the world in terms of McDonald's.
Right. This is what you're talking about in 2017 when they sold off control of their restaurants in mainland China, Hong Kong, and Macau for $2.1 billion, part of a broader strategy to own fewer restaurants, leaving it to franchisees with knowledge of local markets to run their own locations.
I know McDonald's doesn't necessarily want to be in the restaurant business. It wants to be in the franchising business. But
by the way, in 2023, they bought back Carlyle's stake to own 48% of it.
So now they own 48% of it.
Oh, got it.
But you won't find that anywhere on their books because they own it through the equity method. And so it's not integrated. So you're buying McDonald's for, what do we say, $180 billion, $190 billion, but they've got a $20 billion business that they own half of that's nowhere to be found on their books.
By the way, we do see the profits at the bottom line, but we're not seeing the top line revenue. Is that
the businesses are not consolidated with McDonald's Corporation.
Okay, because
the franchise fees are part of McDonald's Corporation.
Got it.
But all of those restaurants and the earnings of those restaurants are not consolidated with McDonald's.
Okay.
They're not. They're owned by the equity method, which means McDonald's can show the dividends they get from those restaurants, but not those restaurants' earnings. Anyway, the point is that this is one of the little magical, wonderful things about these kinds of power law winning companies. They're all sort of like the little Russian nesting dolls. The deeper you dig into these companies, the more good stuff you find. Whereas if you look at most businesses, when you start opening up the kimono, it's, oh gosh, oh boy, oh no.
Mm-hmm.
But these power law winners, I bet you that Google has millions of different closets full of all kinds of interesting IP and tech stuff and all kinds of different assets they could spin off or monetize if they were in a pinch. And so does McDonald's. And so when you buy these kinds of companies, these power law winning companies, there's usually layer upon layer upon layer of value that as you begin to dig and uncover, you'll discover. And for me, in this process, the last couple of weeks of research, discovering that McDonald's China was not integrated into their accounting was news for me. I think there's a lot of hidden value there.
Yeah. So backing up, why don't we just give a little bit of history to our listeners? McDonald's first international unit was in 1967, so just a couple years after they went public in British Columbia. Then in 1970, first one outside North America was San Jose, Costa Rica.
Well, isn't Canada a state? That's an inside joke. My wife is Canadian.
Okay, so if we count Canada as the 51st state, we're going to get some nasty graphs for that, I'm sure. The first outside of North America was one in Costa Rica in 1970, and then they really started rolling things out in 71.
Wouldn't you love to know, maybe somebody out there does, who was the franchise owner in Costa Rica in 1970? I bet you that guy was a groovy guy.
Yeah, 1971, your first McDonald's in Europe in the Netherlands, first in Asia in Ginza neighborhood of Tokyo, first in the Southern Hemisphere in Australia, in Sydney. They were off to the races internationally. And there's, again, what should investors be looking for here is companies that have a product or service that can, you prove out the concept and grow it in the United States, but then it can grow for decades. Getting back to the whole point of this podcast, of course, is finding the kinds of businesses you can tuck away and own long-term compounders. Generally, there's got to be an international angle there. So obviously all the big tech companies are good examples. I remember owning Netflix, right? They hadn't really started international back in 2012 when I was loading up on the stock at its lows. And international was one of the big drivers. I would say the second would be developing original content. And the third would be having pricing power over time, were the things that turned Netflix into a 90 bagger. But international was a big piece of that. Coca-Cola going back 100 and something years. But again, it's easy to look back and say, oh, it's obvious that Netflix would be a hit elsewhere, McDonald's would be a hit elsewhere, everyone would like Coke. But, I could cite all sorts of examples of companies that fell on their faces internationally. Walmart, as great a company as it is, has had a very mixed record internationally.
I think the most interesting thing about McDonald's internationally is McDonald's was so successful internationally that it essentially represents America to most people in foreign countries.
Sure. When they opened up for their first restaurant in Moscow, it was viewed as a symbolic détente.
And it brought a message of peace.
Yes, and 30,000 Russians on the first day went into that restaurant. I have eaten in that restaurant. I have spent a grand total of 15 hours in Russia in my entire life. I had a long layover in Moscow returning home from Italy one year, and the cheapest way to get home was to fly Aeroflot from Italy to Moscow with a 6 a.m. to 8 p.m. layover or something like that, and then a nonstop from Moscow.
This is a true value investor.
It is true.
By the way, he's a guy who knows the price of everything but the value of nothing. He's taking his own life in his hands by flying Aeroflot.
Yes. Well, interestingly, I digress slightly here, but I will pay up to fly nonstop because it's quicker and all. But if I do have to do a layover, or if there's an opportunity to do a layover, I deliberately schedule a long one so that I can go in and see a new country or a new city or something like that.
Power law analysis and travel tips.
Yes.
From your friends here, Whitney, Tilson, and Porter Stansberry.
I'm not sure what more there is to say about McDonald's international story other than it's just been wildly successful. And another aspect, by the way, I do want to mention is another area of growth. So they started to grow internationally. Mm-hmm. We can talk about breakfast in a little bit. Yeah. But also another big step was when they opened their first restaurant in New York City in 1972. So we can see this period from 1970 to 72, let's say. It was a period of extraordinary innovation where McDonald's had grown the business now for many years, just in suburbia, lather, rinse, repeat, boom, boom. Just in the United States, just with its regular menu, certainly wasn't open for breakfast. And in all these areas. So incredible innovation here.
It's a good point, because I think you could have fairly said at any point along the way, the big period of growth is now behind us. But McDonald's management currently says they plan to continue to expand their footprint by 4 to 5% a year, which is 2,000 new stores a year. So plan to reach 50,000 locations by 2027. And they say that means this will be the largest period of growth in McDonald's history.
Yes, not on a percentage basis, but yes.
But that's pretty incredible. I also want to talk about how their business model has really evolved. This might be a little too much accounting for most listeners, but again, there's sort of 3 ways you can make money in business. And one is with just simple profit margin. The other one is with inventory turns.
Right, asset turns.
Yeah. Yep. And then the third is with borrowing money, replacing your capital with borrowed capital, with leverage. Up until about 10 years ago, McDonald's owned about 25% of their stores. The corporation owned the stores and they franchised the rest. Starting in 2014, they began to divest the stores. That has had the impact of reducing growth and revenue, because as they sell a store, they lose that revenue outside of the franchise fees that it pays. So now they're down to only owning about 5% of the stores. So if you go back and look over the last 10 years, the revenues look flattish, but look at the margins. If you look at the operating margins, they've increased dramatically.
Going back to 1990, let's use operating margin, EBIT margin, was in the 25%, very healthy range. Then we can talk more about sort of what happened from 1999 to the bottom in early 2003. when I had a great opportunity and didn't miss it to load up on the stock, and the stock went down by 75%. Operating margin went from 25% to 18% at the low. And since then, it went back up to, call it 30 from, 2010 to 15 or so. And
now it's in the 40s.
Right. And then they started refranchising a lot of their company-owned units. And that had the effect of reducing the percentage of revenues that came from relatively low margin business of operating a restaurant into the almost perfect highest margin business in the world of simply collecting royalties from both owning real estate and franchise fees on top of that. And so trailing 12 months operating margin is 46%.
Incredible.
Now, just astonishing.
So
after-tax margins are 33%, among the highest of any business of scale in the world.
Yes, exactly. So I would argue that McDonald's is in the most elite group of businesses. It has the highest quality brand recognition. It has the highest quality operating margins. It has the highest quality corporate credit rating. Also, unlike many of the other businesses in this group, it is in one of the most stable industries and businesses of all time that is very hard to imagine a day where people around the world will not want to go out and get a quick burger, fry, and a Coke. No matter how much AI happens, no matter how much changes are into healthcare, transportation, it's hard to imagine that my grandkids and their grandkids won't want to get a burger, a fry, and a Coke. Now, will that be McDonald's that's doing it? Of course, that's harder. You've got to have all kinds of good management decisions. But when you have all of the locations, when you have the world's leading brand, it's not hard to imagine that in 100 years, there will be 100,000 McDonald's, not 50,000, and that their margins will still be at 46 or 48%, and that people will still be eating burgers and enjoying Cokes and fries.
Yep. I think I can tell you that when I was raising my three daughters, now 28, 25, and 22. So rewind the clock 20 years. The single favorite thing I could do is take them to Disney World, but that was maybe once every year or two. But what I could do on a regular basis was take them to McDonald's. Mm-hmm. And I have so many special memories from it. And it's funny because one of my daughters is a vegetarian. They're all healthy eaters. None of them would ever set foot in McDonald's today. But back in the day.
Well, wait till they have kids.
Well, here's the thing. It is 100% certain that I will be doing the same with my grandchildren.
Yeah.
I would argue it's 99% certain that the next generation, and 20 years later, there aren't very many businesses where you can say that. And of course, if you're looking at stocks to hold for decades, of course, the business has to exist.
I'll tell you something that I think is another sign of just what a power law winner it is. It's really hard to take so much capital out of a business without losing control of it. McDonald's borrows the capital of their franchisees. It borrows a lot of money to finance its operations. It is an incredibly capital-efficient business, even though it's the largest brand in the restaurant business. And what an amazing business this is. 96% of Americans have eaten at a McDonald's.
Over their lifetime?
Over their lifetime, yeah.
Right, because I would say it's 90% over the past year, maybe.
Sure. Virtually everyone in the country lives within a 3-minute drive of a McDonald's. So they've got incredible distribution. How about this? McDonald's is so powerful that the Coke that is served at McDonald's is the largest distribution of Coke syrup in the world. Coke's dominance over Pepsi in fountain distribution is incredible. They do 50% more fountain distribution than Pepsi does. But if McDonald's switched to Pepsi, Coke's dominance would disappear. So in other words, McDonald's is so large that the syrup they distribute in their restaurants ends up creating the entire advantage that Coke has over Pepsi in terms of fountain sales, not in terms of all the other kinds of distribution. Right. But it's amazing. How about this? 1 out of 15 Americans has worked at a McDonald's. I suspect that means it's also the most common first job that Americans have.
Yeah, certainly for any one company, I have to imagine.
For any one company. Now, let's talk about what just an incredible business this is. It collects $10 billion a year in rent, and it is currently able to pay out 125% of its free cash flow without weakening its balance sheet because it's increasing its leverage to maintain a steady multiple of EBITDA to debt. So there's a fixed leverage ratio that allows it to pay out more than the cash it's actually earning.
Right. Its current total debt to EBITDA ratio is 3.3 now, which is somewhere in the middle of large American corporations.
It's modest.
It's modest and appropriate. They're not in the restaurant operations business. They're in
In the real estate and branding business.
hard to think of more stable cash flows than a fixed percentage of sales of the better part of 40,000 McDonald's all over the world. You've got international diversification. You could safely put quite a bit of debt on this business. And that's actually one of the things my friend Bill Ackman was recommending. This would have been almost 20 years ago when he was pushing McDonald's, and McDonald's listened to him and looked at their balance sheet and said, we're now a more mature cash flowing company. We don't need to be financed as if we're a riskier growth company. And so they've taken on a lot more debt over the years. In recent years, they just take on a little bit more debt each year. In other words, they pay back, just for the numbers of the trailing 12 months, $9.5 billion of operating cash flow, $2.5 billion of capital expenditures. So that leaves $7 billion of free cash, of which they pay out $8 billion to shareholders, about $4.5 billion in share repurchases, $3.5 billion in what is a 2.6% dividend yield today. So they generate $7, they pay out $8. So debt went up by $1 billion over the previous year. But keep in mind, the business has grown, EBITDA is higher. So the ratio, that's what you were talking about, actually the leverage ratio stayed about steady.
Yeah.
That wasn't always true. They have increased debt 10 odd years ago. For many years, debt was pretty steady around $10 billion. And then they decided we can safely carry quite a bit more debt, and they started ramping it up. It looks like in around 2014, 15, they went from 10 billion up to 30 billion. And then in 2019, they took it up to 46 billion, repurchasing a lot of stock. And it's stayed in that area. Here's the thing that's incredible. If you ask me for one metric to measure the quality of the business, it wouldn't be profit margins or asset turns. It would be return on equity, which is a function of profit margin times asset turn times leverage. I looked at McDonald's return on equity, and it said for the last bunch of years, it says NM, not meaningful. There is no return. How can there be no return on equity for McDonald's? But
There's a return on capital employed.
right. But in other words, back when they did a huge share repurchase, when they took their debt up from 10 billion to 25 billion, that share repurchase, when you return cash to shareholders via share repurchase, it reduces your equity. And in fact, McDonald's equity turned negative and has stayed negative, which McDonald's as recently as 2013 had 16 billion of equity. And 6 years later, by 2019, they had negative 8 billion of equity. And today it's
24 billion in share repurchases.
Exactly. Equity, very simply, is assets minus liabilities. So when there's 4.8 billion of negative equity today, that means McDonald's liabilities, things they owe to other people, is more than their cash and inventory and land, property, everything, all the assets. And that's almost unheard of because almost no company does that because it's super risky when your liabilities exceed your assets. But in McDonald's case, it has one of those incredibly unique businesses where they can do it.
Coke's the same way.
Yeah.
That's really sort of an accounting mirage. One of the big things that's missing on its balance sheet is goodwill for its brand.
Right.
So the goodwill on McDonald's balance sheet is only $3 billion.
Right.
What's its brand worth?
Right. Untold.
The reason why it collects $10 billion in rent is not just because it owns lots. It's because those lots have golden arches on them. So let's ascribe the brand value to half of the rent value.
Right.
All right. What's the multiple on $5 billion in rent? Let's say it's 10 times. That means it's a $50 billion brand. And that's completely missing from the balance sheet.
Yes. But for comparison, I pulled up Coke right now, and Coke has 28 billion of equity right now.
So I thought they were already in the same position where they'd bought back so much stock that they had negative equity. I guess I've got it wrong.
Yeah, well, I'm looking here. I'm pulling up the spreadsheet. But here's one of the reasons why I think McDonald's can do it and Coke can't, which is McDonald's runs a beautiful negative cash conversion cycle in that McDonald's buys from its suppliers all the meat and potatoes and all of that. They sell it in a matter of days. Then they instantly collect the cash. Most people are paying via credit card, let's say. And so they're collecting that cash within a matter of days. But then they don't have to pay their suppliers for whatever it is, 60 or 90 days. So that creates a permanent, almost like float, where their suppliers are financing the business. That is very different from Coke, which it takes Coke quite a bit of time to run everything through the whole system of creating the syrup, selling it out into the channel. They're selling it to large corporations like McDonald's or to supermarkets, and those suppliers might not pay Coke for 30 to 90 days, right? So I think the answer, if we compare those two, we would see it's the difference in the cash conversion cycle, and McDonald's has a beautiful one.
The other issue, though, I think that's hidden from McDonald's balance sheet is I suspect there are gross exaggerations of the depreciation of their buildings. And I know that all their real estate has to be held on their books at the acquisition cost. I have a feeling that lots they bought in the suburbs in the 1950s and 1960s have appreciated somewhat.
Yes.
So I think there's some hidden assets there. So I'd say that has an impact as well. All right, let's go to strategy. Is McDonald's such a great business that you believe, like I do, that it's a Powerball winner?
It is the kind of high-quality business where if I were to get back into running a fund again, which I did for 18 years, but this is consistent with the advice that I give to my subscribers now at Stansberry Research, is look for high-quality businesses that are long-term compounders where you can own a concentrated portfolio with an average holding period of as long as possible. I'm increasingly convinced that in a market that is picked over by so many investors, and I'm focusing on the U.S. stock market primarily I'm talking about here, but also the rise of artificial intelligence, and really even prior to that, the quant funds, the supercomputers that are finding any kind of inefficiencies in the market. Because I remember 25 years ago when I first started, you could buy spin-offs. That was such easy money. And there were all sorts of market inefficiencies that I was seeing back then. I don't think it's surprising that my first 10 years from 1999 through the global financial crisis were my best performing years. And my worst performance was in the last 7 years. So the question is, how can you win in an increasingly competitive game? Capital efficient, high quality businesses that still have an incredibly long growth runway, et cetera. So McDonald's clearly falls into that category. The challenge for all of us, and for you and me and every investor, is every other person, every other investor on the world, in addition to every supercomputer, can see that McDonald's is a great business. Today, it's valued at 9 times revenue, 15 times EBITDA, 22 times trailing earnings, 21 times this year's earnings estimates. I would actually argue when you have the S&P 500, depending on whether you're looking at trailing or this year's estimates or whatever, trading somewhere in the low 20s. The S&P 500 today it's hit 30-odd all-time highs this year. It's run up a bunch. McDonald's is trading at a market multiple. So if you ask me, do I think McDonald's stock purchased at today's valuation, today's price, versus just buying the S&P 500, I think McDonald's stock is over, let's say, 5 years at least, certainly over 10 years. I think I would say it's 80 to 90% likely to do better than the S&P 500. I happen to own some of the S&P 500 in my retirement accounts, in addition to some stocks. So you might ask, well, why do you own the S&P 500 if you think McDonald's going to outperform? And obviously the S&P 500 is more diversified. You're not taking single company risk. Where I really get excited and what I'm looking for and what I'm trying to deliver to my subscribers is if you can get into one of these stocks and the long-term compounders and build a 10-stock portfolio of stocks acquired when they're beaten up and out of favor, and you can buy them at half of what they're worth or less, and then from that point, hold for 10 or 20 years.
Exactly.
That's what you really need to look for, because buying a portfolio of, we've talked about McDonald's, we've talked about Coke, we've talked about Berkshire Hathaway, we've talked about Costco. You mentioned Amazon. I might throw Google into that mix as well. You buy those 6 stocks to Hershey. Let's add that. We can each add our favorites. So now you've got 7 stocks to a 10-stock portfolio. I'm willing to bet those 7 stocks would mirror what the odds I just gave you on McDonald's, which is 80 to 90% likely to outperform the S&P 500 over the next 5 to 10 years, but not by a large margin. Let me caveat that.
Not at all.
I think the S&P from today's price might compound at, call it 5 or 6%. So I think that basket of stocks, including dividends, might do 8%, 9%, which is better than 5 or 6%. But that's only a couple, 2-3 percentage points, maybe I'd say 3 percentage points outperformance. So that's month in, month out, we're churning out good ideas like that. that we try and share with our subscribers. But where you really get excited is McDonald's in early 2003, Meta platforms, i.e. Facebook, less than 2 years ago.
2022, yeah.
Okay. That was a year and a half ago, and it's gone up 5x.
Yep.
And we should talk about that because I absolutely nailed that and gave it to my free subscribers, not even my paying subscribers. It was such a layup. Netflix back in 2013, which is a higher risk, higher reward kind of thing, but a 90 bagger off the lows. And I went on national television and gave that idea away to all the millions of viewers on CNBC and at my investing conference the very day it bottomed, right? So that's what you want to look for, but those are harder to find.
Sure. And I don't remember, you weren't with me, but you did exactly the same thing that I did, which was on or about March 23rd or 24th in 2020.
Sure.
When the entire stock market was down 30%.
Yeah, I think at the
day
it was down 35% in 6 weeks.
I recorded mine, I think, a day or two before the bottom. You happened to record yours the day of the bottom.
Right. I think you were on the Friday and I was on the Monday.
But we were so close to the bottom, it doesn't make any difference.
Yes.
And those are the moments.
Yes.
And I don't believe we're anywhere near that right now with McDonald's. And here's an interesting question. Would you rather own Meta for the next 25 years or McDonald's, assuming you could buy both of them for the same relative price?
By the way, they happen to be trading at roughly the same price if you back out Meta's cash and so forth. Meta might be a couple PE turns higher, but they are similar price. The answer is clearly McDonald's in my mind. It doesn't have quite the same growth prospects. It's a more mature business. I believe Meta today, its economic characteristics are just inherently better as a tech business where the customers are supplying all of the content and they're just monetizing it and all. That said, it's a tech company. It's riskier. And when Meta, that question 2 years ago, when Meta had declined by 75%, and I was just pounding the table, that's the nice thing about a stock like Meta. It's going to be a more volatile stock, which is going to give you more opportunities. The shareholders of tech companies and the underlying businesses both tend to be more volatile.
They bounce around.
And so you can find NVIDIA a few years ago went down a ton as well. In 2022, all the big 7 tech stocks went down a ton. And I was pounding the table on every single one of them. But I specifically called out Meta as my favorite because the others were down, 30 to 50%. And Meta was down 75%.
I think that Meta has more, I'll probably regret saying this in the future, but I think that Meta's business is fundamentally more stable than something that is a business to business. I feel the same way about Apple. Apple has so much of my content. I've got my music, I've got my movies, I've got all the text messages I've ever sent. They're all locked in Apple's walled garden. And so therefore, Apple has a much greater likelihood of having me as a customer in another 20 years than does Microsoft, just to name one. And Facebook is the same way, right? I've got 10 or 15 years of my life on Facebook and pictures of my family and all these things. So it's hard for me to imagine that they would do something foolish enough to lose the trust and appreciation of their customers. Whereas something like NVIDIA, I'm not saying NVIDIA is going to go away. I'm just saying that they have to continue to produce at the razor's edge of innovation to maintain their leadership.
Yes, and their valuation is so extreme today that there's a lot of room for it to fall. Even if the company does well, it's got to perform spectacularly well to justify that valuation. So you could end up with a stock that's just flat for a while.
And I think that there are power law winners that you and I are able to analyze and understand. And then there's going to be power law winners that, frankly, I'm definitely just not able to fully appreciate. I cannot understand even now what the hold that NVIDIA has over its customers is. I can regurgitate it to you,
right?
But I do not understand it the way that I understand why I use Meta, why I use McDonald's, why I use Apple. And I think if you don't have a real appreciation for what it is that binds the customer to the company in question, it's much harder for you to invest with real conviction.
There's a simple, obvious answer, which is they're providing the chips for AI in a massive land grab, and they have the best chips and the greatest supply or whatever. The tricky part about NVIDIA, which is why I can't own it, isn't just the valuation, but there are a million competitors, and the actual purchasers, the Googles of the world, the Amazons of the world, are trying to develop their own chips in-house. Those are pretty innovative, deep-pocketed companies that don't like paying a king's ransom to NVIDIA every year. So it's very hard to game out.
I'm with you. Think about how many king's ransoms do end up being paid for so long. The entire tech infrastructure has hated paying Qualcomm's ransom since 1996.
Yeah.
And they tried everything in their power to stop it. They tried legislation. They tried controlling the different tech standards. They tried defrauding Qualcomm, stealing the technology. And yet Apple this year will still spend billions paying Qualcomm royalties for its technology. I'm not saying you're wrong about NVIDIA at all. I don't know either. And that's why, for me, I would much rather say if I have to buy a stock for the next 10 years and I'm not allowed to sell no matter what, right, I'm comfortable making that kind of a bet with McDonald's. I'm not comfortable making that kind of bet with NVIDIA.
Yeah.
And I will admit that it's not unlikely that caution costs me money. I'm really okay with that. What I want as an investor is an acceptable return. It's impossible to try to pretend that I can make the maximum return every time I make an investment.
Right. So it's interesting, Porter, we were just talking about, you mentioned the latest, greatest opportunity at the bottom of the COVID panic. And I actually just pulled up, you were doing your pound the table the previous Friday. This was me on Monday. And I actually gave 10 stock recommendations, and I broke them, though, into two categories, conservative and risky. And so my 5 conservative stocks were Berkshire, Amazon, Google, General Dynamics, and Altria. My 5 risky stocks were the beaten down stuff that had really gotten clobbered by COVID, TripAdvisor, Spirit Airlines, Capri, a retailer, Penn National Gaming, a gambling company, and Howard Hughes, a real estate company. It was a group of stocks that in a market that had fallen 35% in 6 weeks, the blue chips were down 30-odd%, but the risky ones were down 80%. And here's what's interesting. The whole basket did well, but if you bifurcate it into the conservative stocks, in a period of time, the S&P since that day, through this very moment that we're recording here, S&P's up 121%. The conservative stocks are up 126%.
Same as the S&P.
Exactly. A little bit. And that doesn't count dividends. So it's actually call it a couple percentage points a year better than the S&P, which is nice.
That's great. Yeah.
The aggressive stocks have only gone up 29% in 100 plus 121. But here's the thing. If you measure it to the peak before they've come down, for example, let's just give a simple example like TripAdvisor. We recommend it $19. Today it's at $17, down 8%, right? It's dragged down the return of the aggressive portfolio. But it actually went from 19 to 61 during the pandemic recovery that was the core of our thesis. In fact, if you take to the peak of the 5 aggressive stocks, which as of today are only up an average of 29%. At their peak, they were up an average of 358%.
Yeah.
Because, for example, Penn National Gaming went up 9x before coming all the way back.
The moral of that story is the things that are not power law winners, you have to follow a trailing stop with. And the things that are power law winners, you have to not follow a trailing stop with.
Yes.
And then you have to have the wisdom to know the difference.
Yes.
The idea that you're going to sell McDonald's because it has a bad quarter and falls 25% is nonsensical.
Right.
The idea that you're going to hold Penn National forever is nonsensical. It does not have a fundamental advantage. It's in a very competitive space.
Right. And so let me give an example of the 3 monster winners I mentioned earlier. Meta up 5x in the past 2.5 years. Netflix at the bottom in October 2012, up 90x in the next 8 years. And McDonald's, from 1965 when it went public to 1999, 34 years, McDonald's was one of the greatest growth stocks of all time, was one of the most widely held stocks in America, peaked at $48, and in the next 2.5 years or so, 3 years, it went to 12. And I know because I was buying it that day at $12.50 a share. And since then, it's up almost exactly 20x from 13 to 260, roughly speaking. Here's what's interesting. From their recent peaks, how much did each of those 3 stocks decline?
McDonald's?
Like a year earlier.
Meta?
So McDonald's, I just told you, went from 48 to 12, 75% decline. How much had Meta gone down in the previous year or so from its recent peak to its bottom in November?
22?
Up 22.
I would guess 75%.
75%.
Yeah.
How much had Netflix gone down? when it bottomed in October.
Probably 75%.
75%.
Yeah.
Now, here's the thing. Those three stocks, we would both say those are your long-term compounders.
And they're going to have huge drawdowns.
We would not have used a stop loss, and we would have had to endure 75% drawdowns. And that's okay because we're going to own 10 of those stocks.
And if it were easy, anybody would do it.
Exactly.
And by the way, when you have a Powerball winner, you don't sell, you do the opposite.
Yes.
You buy every time it goes down another 10 points.
Yes. But here's the key. You have to know what you're doing because
you got to know the difference.
There are so many stocks where they're down 20% and you better have a stop loss in and get out. Like Penn Gaming, the biggest winner from my March of 2020 portfolio, went from 14 to 136. It was up 837%. And where is it today? Back down to 19.
I want to say one more thing about all this. The purpose of these podcasts is for us to do deep dives and learn ourselves and share what we've learned with our audiences. The other thing is to try to be ready to buy these businesses when the opportunity approaches. And here's what's so fascinating about that. That's not hard for me to do, Tilson. I don't mind buying stocks after big blowouts. The market doesn't scare me because I think I know what the businesses are worth. But what I do end up doing is trying to buy the one that's fallen the most instead of simply just recognizing that buying the great business when you have the opportunity to is the way to go. Let's say we wake up tomorrow morning, the stock market's fallen 50%. Who knows? Russia rattles the saber and people think we're going to have nuclear war next week. Stock market crashes. You and I decide we're not going to have nuclear war next week. We go to work. And what we will do, I bet, is we will look for the marginal quality business that's now trading for nothing. Because we are exactly right that over the next 9 weeks, the return in that stock will be larger than the return in McDonald's. But what we forget is we will not have the opportunity to buy McDonald's at 9 times earnings in 90 days. That opportunity will go. And it's very hard to have the discipline to actually buy the highest quality compounder instead of the thing that is dirt silly cheap.
Right. And look, I think the lesson of what happened with those 10 stocks I recommended, the 5 conservative, 5 aggressive in March of 2020, is that I'm glad I gave my subscribers 2 types of stocks and a reasonably diverse, 5 of each, not just one. But if you're going to buy the more aggressive stuff, you have to understand that this is more of a trade. This is more just predicting that the world isn't going to come to an end. So you get a bigger pop, but you got to sell those. If you just want to focus on the rest of your life and whatever, then just stick to the blue chips, the long-term compounders. So if I were to start managing money again, I would look to buy a 10-stock portfolio that I would make 1 trade a year. I would swap out 1 stock. My general bias would be to swap out one of the underperforming ones because, one of the keys is to let your winners run. The long-term compounding doesn't work if you sell something just after it doubles. Then you're never going to get a 5 or a 10 or a 50 bagger. But here's the thing. In today's environment, if somebody gave me X millions of dollars and said, I want you to manage this fund. I believe in you, Whitney. If I were to get back into that business, I think off the bat, I might only have 2 or 3 stocks and I'd have to be patient and wait. And it might take a few years. It might take a market pullback or a sector pullback or something to happen to one of those, but I've got at least 100 companies in my head that fit that criteria.
You'd love to own, but you're waiting for a price where the compound returns will be very attractive. I'd like to wind up with one more question for you.
Okay.
Which is, if you could be chairman and CEO of McDonald's for a year, what would you do to turbocharge the business? What would you do to double the value, the intrinsic value of that business in 3 to 6 years or maybe more? Any ideas?
Not really, which is sort of why I don't own the stock today. And it's been an open recommendation in Stansberry's investment advisory dating back to December of 2012. Anyone who followed our advice and has held it with dividends has earned 252% returns. And I'm very comfortable continuing to hold it because it's one of these long-term compounders. And I don't think there's any case of extreme overvaluation here. You can buy one of the world's greatest businesses at a market multiple. So I think you'll do a little bit better in the S&P from here. But if the stock isn't obviously cheap, or there aren't some obvious things that they could be doing differently to unlock value, then it's hard to get excited about buying more of it here, because I don't have an answer to that until I see an answer. So let me contrast this, by the way, with when I was thinking about selling it. I bought the stock from 16 down to 12 in early 2003. And then the stock had rallied. It was up at about $33 a share. And now it's tripled. It's 3 years later.
A triple in 3 years is a pretty good annualized result.
That's right. And being young and stupid at the time, I was thinking, okay, don't want to be greedy, which of course is the exact opposite viewpoint you should have. I now understand you must be greedy if you find a great company and you buy it at an attractive price. You need to make 5, 10, 20 times your money on stocks like that. Doesn't appear so cheap anymore. I bought it from 16 down to 12, thinking it was worth 25. A few years later, things had gone well, so I had moved my estimate of intrinsic value up to, let's just say, $40, and stock was at 33. Doesn't seem that cheap.
Yeah.
Time to move on. I can surely find something cheaper.
Not easy.
And then Bill Ackman came along, and he had so much conviction in this idea, in fact, that he raised a special purpose vehicle for it and raised a lot of money and came out with a big slide presentation. It was a 79-slide presentation.
What was the date of that?
November, I don't have it here exactly what day, but November 2005.
Okay.
And this
is right in the middle of the supersize me controversy.
Well, yeah, one of the reasons the stock had gotten cheap was this foolishness that Americans were all of a sudden going to start eating healthier and weren't going to eat the bad food at McDonald's.
That's not going to happen.
That had been going on for years, and that's part of the reason the stock had gotten down to $12 a share. But I was just looking back in my notes when I was buying McDonald's into 2003, one of the best buys of my early career. One of the reasons McDonald's got into a bunch of trouble is they had been using aggressive accounting, and if the underlying business doesn't really take off, that aggressive accounting to come back and bite you in the butt. And that's one of the reasons McDonald's stock went down by 75% when it finally caught up with them. But I had so much conviction in McDonald's back in early 2003, and I had done an interview with a McDonald's franchisee that I thought was particularly insightful, where he pounded the table and told me what was going on inside the company. And keep in mind, he was a franchisee, not at corporate. He wasn't passing me inside information because he didn't even work for the company. But he gave me his experience as a franchisee and said the new CEO, Jim Cantalupo, is fixing all the dumb things prior management was doing and all that had caused the stock to go down by 75%. And I thought it was so interesting.
Like buying the pizza shop and
right,
put a manger.
Well, the worst thing they'd done is started a price war with Burger King, and they were discounting their premium, their Big Mac. McDonald's has always had, a little part of the menu, the dollar menu and so forth, where they're targeting super price conscious people. But McDonald's had always marketed itself for decades as a family-friendly place where you could come and get good, tasty food. And it never marketed itself as this is the place with the cheapest food you can find, though in fact it did offer great value. And so they had done everything wrong, and they had failed to innovate and create new products, et cetera, et cetera. And the franchisee had laid all this out, what all the mistakes were, and then told me how the new CEO, who had just come in a few months earlier, was fixing it all and returning McDonald's to its roots as a great company. And I had so much conviction in one of the very few times, and I could count on one hand the number of times in my life that I have actually written to Warren Buffett telling him about a stock. And this was one of them. And he sure should have bought it at the time. But he did actually, I think the only time, or one of only 2 times, where he actually wrote back to me. And he had actually written, his secretary had printed it out because he doesn't have email. And he had written and had circled the comment I made about the hidden value of McDonald's real estate. And he simply pointed out that the McDonald's, yes, it owned valuable real estate, but it wasn't going to help much if McDonald's mismanaged the business and couldn't make a go of it with the McDonald's on that piece of real estate. It isn't like McDonald's could then turn around and sell it for some high value for some other use if McDonald's couldn't make a go of it, which was a fair point, but an irrelevant point, really. That wasn't a major part of my thesis. Of course, the major part of the thesis was an insanely great business that had not gone south. It was encountering short-term problems, mostly of its own creation, and that a new CEO is already in and fixing those problems, and therefore it was going to quickly return to its former glory. So where Bill Ackman got involved and saved me from myself, on the verge of selling it 2 years later after this fabulous investment, 2.5 years later, in late '05, Bill came along and laid out in a 79-slide presentation the things McDonald's could do to unlock all sorts of value. And the key pillars of it were he wanted to split the company into two pieces, which the company didn't end up doing. But he's like, what people are missing here is people are valuing this company as if it is a restaurant operating business, a relatively capital-intensive, low-margin business. But what it really is the greatest business in the world, which is just gets a royalty on the franchisees' hard work and low margins and so forth, relatively low margins. And so McDonald's ended up it did take his advice in terms of the way it reported its numbers, such that investors could see the two different pieces of the business. And therefore, over time, its multiple expanded and so forth. So that was one important thing that Bill pointed out. And secondly, he said, you don't need to own 30% of your restaurants. You can own 5% of them.
And they took that advice too.
It was a refranchising.
It took about 10 years for them to
So they implemented the Ackman plan from 2005 to roughly 2015. Mm-hmm. And then they implemented the financial engineering piece of it that we discussed earlier of buying back a ton of stocks, taking a return on equity to infinity by taking equity actually into negative territory and recognizing that the company could safely carry more debt. So they took on debt to implement this. And that really took the stock up, another leg from $100 to $250 a share, which is where it is today. So you asked me a question, what could McDonald's do today? What would my 79-slide Ackman plan be for what the company could do to unlock value? And I don't see any major levers. I don't think management, either in terms of the way it is operating and growing the business or in terms of what they could do with their balance sheet and on the financial side. I think they've, over the past 20 plus years, picked a lot of that low-hanging fruit, executed superbly. And so now I think what you're looking at is a business that still has decent growth prospects, should be able to grow with population plus opening new restaurants. So call that 5-6% top line growth. As they grow, should be able to expand margins a little bit. So now you're into high single digits. They're buying back stock, $4.5 billion. So that's about 2% of shares outstanding, a little over 2%. And they're paying a 2.6% dividend. I think in the next 5 years, if they just continue to execute, you've got a stock that compounds in a 5% S&P 500. This is a stock that's going to compound at 7 to 10% with dividends. And that's very satisfactory if I owned it. But in terms of if I were building a new portfolio from scratch, I'm waiting for something that shocks the stock and gives me, I'm not going to wait for down 75%, but down 10 to 15% trading in a range for 2.5 years isn't the kind of thing that gets me excited to put new capital to work.
I'm buying it all day long at 15 times trailing earnings if or when that day arrives.
Yes, it's at 22 times now. So that would be, assuming earnings don't change, that's down 30% from here.
And I have seen, if you're patient, you get those opportunities. I've seen Hershey at that price before, and I think you will get that opportunity. If I could be the chairman and CEO of McDonald's for a year or for a couple of years, what I would want to do is reinvest more and building out our restaurant business. And the way that I would do that is I would look for any brand in my space that I think is competitive or could become very competitive with my backing. Today, I think that's Shake Shack. And what I would do is I would borrow the money to buy Shake Shack. So I'm making my business a little bit more levered. And then what I would do is I would give every single person who's a McDonald's franchisee the right to build a Shake Shack as well. So if you own one franchise, you can have one Shake Shack. If you own 21 franchises, if you want, you can build 21 Shake Shacks and partner with our franchisees to build out a version of our restaurant that is essentially the same thing, but much higher margin. At McDonald's, restaurant operations are fairly low margin. I estimate the operating margin at most franchises is between 10 and 12%. I think that with a Shake Shack, you could probably get that to 18 to 24%. And that would be great for the franchisees. They would get super excited about that. And the trade-off is instead of a 5% franchise fee, I'm going to get a 7.5% fee. And you've got to pay me a good amount of money for the franchise up front. And that, if you did that, you would light a fire under the market's belief in McDonald's as a growth system. We're not just going to have one burger franchise. We're going to have burger franchises at the entry-level price and at the premium price. And maybe someday down the road, why can't we build a Chipotle killer? We know that business. Why can't we have our franchisees help us to build a Chipotle killer?
Yeah. And I just pulled up Shake Shack, $3.5 billion market cap, $3.8 billion enterprise value.
Buy it with a sneeze.
Right. McDonald's has a $236 billion market cap.
We could borrow the money to buy that restaurant by next Tuesday.
Right. Assuming you pay a premium to get it, call it $3.8 billion enterprise value, call it $5 billion, round it. That's 2.5% of McDonald's, and they've already got $48 billion of debt. They could borrow $5 billion more, but maybe they buy it for some stock as partly a stock or cash deal.
No stock.
Yeah, you don't want to dilute. So
we can borrow it easily, and we can borrow it at a fair rate, and our franchisees are going to pay us the money back.
Yeah, and it would be like right now, it's trading at 20 times EBITDA, trailing EBITDA. McDonald's at 15 times, but it's only trading at 3.6 times revenue. McDonald's trading at 9 times revenue. So you'd have to assume part of a larger system.
What you'd have to do, though, is you'd have to make sure that what has made Shake Shack work, that secret sauce, which is going to be different than McDonald's. So McDonald's is value, speed,
right,
cleanliness, family friendly.
Yeah.
That's what makes McDonald's tick. There's something about Shake Shack that makes it tick. I don't know the business well enough to tell you what it is. But whatever that is, you've got to continue to invest in that. You cannot let Shake Shack become McDonald's. It's got to stay Shake Shack.
Right.
I would much rather McDonald's take $5 billion and do that for the next 10 years, build out Shake Shack nationally, internationally. Woo, home run.
Right. Now,
and then it also proves that McDonald's is a growth system, not just a restaurant franchise. We know it's already worked in 18 different countries. That's proof of concept. And you know that McDonald's has global distribution, global marketing, global legal, global HR.
Sourcing, supply.
Okay. How much do you say it's worth?
Today, it's $3.8 billion. It's
right. Say to buy it. It would be $5 billion.
Buy it.
And it's 500 restaurants? Okay. Well, we can take that. We can go from 500 restaurants at Shake Shack today to 5,000 restaurants in the next 7 years. And that is worth a lot of money, even with McDonald's scope. Anyways, if anyone out there is listening and has connections at McDonald's, I would love to have a conversation with McDonald's chairman and CEO about that idea. I'd also love to talk to him about the number of countries where there are not yet franchises available, like at Tanzania, for example. There's a whole business to be had in being franchisees of McDonald's where they don't yet operate. And I'm interested in doing that business myself. Please ring us if you are listening, Mr. Chairman of McDonald's. Okay, Tilson, it's time to wrap up. Do you have any parting thoughts for the listeners?
The most important thing in an environment like where markets are near all-time highs is the surest way to get poor quickly is to try and get rich quickly. And the reason we're talking about McDonald's is long-term wealth creation, which involves patience and recognizing what kind of market you're in. We're in a richly valued market. And so don't rush out the risk curve. Stick to index funds, blue chip stocks, but with modest expectations. Keep studying companies like McDonald's, but just be patient. And don't worry about the lack of exciting things to do today, because that can change tomorrow.
My parting shot is how badly most Americans need to understand the role that high-quality common stocks play and protecting your savings. We live in a very inflation-prone world. We also live in a world where the government is making everybody promises about supporting them during their retirement that they will never be able to keep. So it is more important than ever that you safely and steadily learn how to compound the value of your savings through common stocks. The whole point of this podcast is for you and I to do these really good deep dives to understand the whole business, and especially to understand what the secret sauce is that binds the customer to that brand, and then therefore, hopefully, to have some clarity about its staying power, so that when there is another bottom, which there will be in our lifetimes, another March of 2020, another March of 2009, another Black Monday, 1987, when you do have these about every decade, an opportunity to buy just about anything you want. What I am hopeful that we will be able to do, both in our own portfolios and with our subscribers listening, is be ready. Know what you're going to buy, know why you're going to buy it, and then don't get shaken out of the trade.
Yeah.
We'll look forward to doing this again next month.
I look forward to it.
Thank you very much, Tilson. Thanks to the crew for their patience today. We look forward to talking with you next month. Bye-bye.